Penny stocks. These two words alone can evoke dreams of striking it rich quickly. Imagine turning a small investment into a life-changing sum, a dream many investors chase. The allure of penny stocks lies in this potential for exponential growth, where a few dollars can multiply into thousands. However, this potential comes with significant risk, akin to a thrilling yet unpredictable roller coaster ride. Navigating the world of penny stocks requires knowledge, strategy, and a healthy dose of caution. It's not just about luck. Understanding the dynamics of this unique market can help you make informed decisions, reducing the chances of costly mistakes. It can also help you potentially capitalize on the opportunities penny stocks present, turning risks into rewards. This essay will serve as your guide to understanding and approaching penny stocks, providing you with essential insights. We will explore the fundamentals of what penny stocks are and why they are considered high-risk, high-return investments, often misunderstood by many. You will learn about technical and fundamental analysis, essential tools for evaluating these stocks, helping you to identify potential winners. Finally, we will delve into risk management strategies to help you protect your investment, ensuring you are prepared for the market's volatility. Remember, knowledge is power, especially in the volatile world of penny stocks, where fortunes can change in an instant. Arm yourself with the right information and approach this market with a cautious yet opportunistic mindset, ready to seize opportunities while managing risks. Penny stocks, often shrouded in an aura of mystery and speculation, are simply stocks that trade at very low prices. These stocks can be a gateway to the stock market for many new investors. These stocks are typically priced below $5 per share, although the definition can vary. Some consider any stock under $10 to be a penny stock. They are often associated with small companies or those in the early stages of development. These companies may be working on innovative products or services, hoping to make a big impact. The low price of penny stocks is a major attraction for investors. It allows them to enter the market without needing a large amount of capital. It offers the possibility of buying a large number of shares with a relatively small investment. This can be particularly appealing for those looking to diversify their portfolios. The potential for these stocks to multiply in value, even with a small price increase, is what fuels the dreams of many investors. A small uptick in price can result in significant gains. However, this potential for high reward comes with an equally high level of risk. The balance between risk and reward is a delicate one. Penny stocks are often more volatile than their more established counterparts. This volatility can be both an opportunity and a danger. Several factors contribute to this volatility. These include market speculation, company performance, and broader economic conditions. One key factor is the lack of liquidity in the penny stock market. This can make trading these stocks more challenging. This means there may not be enough buyers and sellers at any given time. The lack of liquidity can lead to difficulties in executing trades. This can lead to sharp price swings, making it difficult to buy or sell these stocks at desired prices. Investors must be prepared for sudden changes in value. Navigating the world of penny stocks requires a keen understanding of market trends and price movements. This is where technical analysis comes into play. Technical analysis is a method of evaluating securities by studying statistics generated by market activity, such as past prices and volume. Technical analysts believe that history repeats itself in the market. They look for patterns and trends in historical price data to predict future price movements. By identifying these patterns, traders can make more informed decisions about buying and selling penny stocks. Numerous technical indicators and tools can be used to analyze penny stocks. Two of the most popular and widely used indicators are moving averages and the relative strength index, or RSI. Moving averages are one of the most fundamental and versatile tools in technical analysis. They help traders and investors make sense of the often chaotic price movements in the stock market. They are used to smooth out price fluctuations and identify trends in stock prices, providing a clearer picture of the market's direction. A moving average is calculated by averaging a stock's price over a specified period, which can range from a few days to several months. There are two main types of moving averages: simple moving averages, or SMAs, and exponential moving averages, or EMAs. Each has its own unique characteristics and uses. SMAs give equal weight to all prices in the period, while EMAs give more weight to recent prices, making them more responsive to price changes. This responsiveness can be crucial for traders looking to capitalize on short-term movements. Traders often use moving averages to identify buy and sell signals, which can be pivotal in making profitable trading decisions. For example, a buy signal is generated when a stock's price crosses above its moving average, indicating potential upward momentum and a possible entry point for traders. Conversely, a sell signal occurs when the price crosses below its moving average, suggesting a possible downtrend and an exit point to avoid losses. Moving averages can be customized for different time frames, allowing traders to analyze both short-term and long-term trends. This flexibility makes them a valuable tool in any trader's arsenal. Common time frames include 50-day, 100-day, and 200-day moving averages. Each time frame can provide different insights, helping traders to make more informed decisions. Section 5. Relative Strength Index, RSI. Gauging momentum. While moving averages help identify trends, the Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100 and indicates whether a stock is overbought or oversold. An RSI reading above 70 is generally considered overbought, suggesting that the stock's price has risen too quickly and may be due for a correction. Conversely, an RSI reading below 30 is considered oversold, indicating that the stock may be undervalued and poised for a bounce back. Traders often use RSI in conjunction with other technical indicators to confirm buy and sell signals. For instance, if a stock's price is above its moving average and its RSI is above 70, it could indicate a strong bullish signal. Section 6. Fundamental Analysis. Unveiling a company's financial story. While technical analysis focuses on market trends and price movements, fundamental analysis delves into a company's financial health and intrinsic value. This involves examining a company's financial statements, management team, industry position, and other qualitative and quantitative factors. The goal of fundamental analysis is to determine whether a company's stock is overvalued or undervalued by the market. Investors use this information to make more informed investment decisions. Several key financial ratios and metrics are used in fundamental analysis. These include earnings per share, or EPS, price to earnings, or PE ratio, and revenue growth, among others. Section 7. Earnings per share, or EPS, and PE ratio. Assessing profitability. Earnings per share is one of the most widely used measures of a company's profitability. It represents the portion of a company's profit allocated to each outstanding share of common stock. A higher EPS generally indicates a more profitable company. The price to earnings, or PE ratio, is another important metric that compares a company's stock price to its earnings per share. It provides insights into how much investors are willing to pay for each dollar of earnings. A high PE ratio may indicate that investors are optimistic about the company's future growth prospects, while a low PE ratio may suggest undervaluation. However, it's important to note that PE ratios should be compared within the same industry. Different industries have different average PE ratios, so comparing a technology company's PE ratio to a utility company's PE ratio would not be meaningful. Section 8. Revenue growth and financial health. Revenue growth is a crucial indicator of a company's financial health. It reflects the company's ability to generate sales and grow its business over time. Investors look for companies with consistent revenue growth, as it suggests a healthy demand for their products or services. In addition to revenue growth, analyzing a company's balance sheet and cash flow statement is essential in assessing its financial health. The balance sheet provides a snapshot of a company's assets, liabilities, and equity at a specific point in time. The cash flow statement tracks the movement of cash into and out of the company. Understanding a company's financial position, debt levels, and cash flow generation capabilities is crucial in determining its long-term sustainability.